Hi everyone. Welcome to not a regular market update session. It's an audio blog, so uh, I just wanted to express our views of what we think about the market, but I don't want to keep this discussion or this session very formal. Uh, this is just a sort of a what we think about the market and what we think about the recent corrections. We just wanted you know to um, to create an audio blog where we tell you about what we feel is happening and why it's happening and what should anybody do regarding the markets. So to start off with the numbers, yes, the markets are falling. There has been a recent correction in the markets. If I see the Nifty 50, it's down by approximately. Last we checked, it was down about 3% YTD. The mid caps are down by approximately 25% YTD, and by YTD I mean year till date. And the small caps are down by approximately 36% year till date. So the broader markets are down, of course. Large caps, the Nifty 50, not by that much, but it is still down. But the mid caps and small caps are down by a significant amount. So, why is this correction happening? Well, there are a lot of short term triggers that we can have a discussion upon. So all of us know that crude has gone up to post it's past the $70 mark, and it was at a point of time approximately $35 a barrel. It's gone up to 70. The rupee has depreciated and we are sitting at a 73, 74 kind of a level for the rupee. So due to which the markets are reacting, because this will ultimately put some pressure on our current account deficit. It has already put some pressure on our current account deficit, and it will also put some pressure on our fiscal deficit as well. So markets are reacting because of the rising crude and the depreciating rupee. So what should somebody do at this point of time? Should they react to such a news in the market? Should they not? These were all numbers. Let me just get to the point of what I feel. What needs to be done. It's important for markets to fall at a particular time. Because if the markets keep on going up, then there is no point of doing an SIP or an STP into the markets, because we'll keep on getting an upper average of our investments. So it's important for the markets to correct, to come down at a point of time, so that we get entry points during that correction. Um, just taking an example out of our regular lives. And we thought over it. I thought over it of how this needs to be related. But if we take an example out of our regular life, if you walk in a group, if a family is walking in a group, the pace of that group is decided by the child or the youngest member. Similarly, something similar happens in a group of zebras or in a group of deers. When they are going in a group, the speed of the group is decided by the slowest member and not by the fastest or not by the leader. And if we take examples out of our own ecosystem, the tiger attacks the slowest member of the group. And when he attacks, after that the speed increases. So I just wanted to correlate this example to what's happening in the market. The weakest investor is attacked when the markets go down by the fear of losing money. But if I talk about the strong investors, they'll enjoy the run after the market. When the markets will go up, they'll enjoy the run of the markets after the weakest investors or the weakest traders are actually filtered out. We feel that watching television and news daily is actually injurious to your health. Uh, and we've kind of always said that news and the media articles are for traders, because the people who are investing in the markets, I think out of 80% or 85% even out of those people who are investing are actually traders. So the news that we see, the articles that we read, are actually designed for traders. And a definition of trader is somebody who has about 1 lakh rupees, for example, and but he's put in the markets approximately 8 lakhs by getting a leverage on that 1 lakh. So he only has 1 lakh to give, and when the in the shorter run, when the market's correct, uh, you know he is the one who is the most scared, or he's the one who is the most intimidated by that correction. And when I'm talking about 80 to 85% of the people investing in the markets being traders, that sentiments kind of reflect in the market when the markets go down, right? So the articles are actually, the news articles and the newspaper media is actually designed for traders. And what happens is, because of this news, a person who is doing a regular SIP, or who is an investor, or who is doing a regular STP, gets scared because of these news. So it's like probably reading somebody else's telegram, for that matter. It's, the news are not designed for long term investors. They are designed, they are made for traders. And I think the investors who have invested in the markets for a longer run have nothing to worry over it, because uh, you know the equity investors would be running their SIPs, would be running their STPs at this point of time, or would be in a balance advantage or a dynamic equity kind of funds, where the equity portions keeps on going up and down according to the price to earning of the market. So the long term investors doesn't have anything to worry at this point of time, is what I feel. The rupee has the last time, if you remember, the rupee depreciated in I think around August 2013, right? There was fear in the market at that point of time also. But if you see markets data from, I think, October 2013, the markets rallied from October 2013, and I think it has reached a point of where the markets reached even 37,000. The Sensex reached 37,000 very recently. So the markets have only rallied after that. So there is really no correlation between the markets and the rupee. And along with this audio blog, I will also send you some graphs to look at. The correlation between politics, the correlation between politics and markets, the crude and markets, the US dollar rate and markets. You will see that in these graphs there are actually no correlation. It's just a kind of a reaction because of the sentiments of the traders of the market, nothing else. The other thing which is happening is the US interest rates are also going up. So so if I'd give you an example of the history, last it happened was in 2004, 2005, 2006, 2007, where the US raised their interest in those years. And if you see the markets in India in that period actually went up. So again, there is no correlation between the US interest rates and as well as the markets as well, in a longer run, of course, right? So if I take another example out of our day-to-day life, if I ask you today, which is the safest mode of transportation in the world, in the globe, according to numbers. Uh, so if I have to give an answer to that, it will be an air travel. But uh, the most fearful as well, surprisingly and contradictorily, in a contradiction, the most fearful is again air travel. So that tends to tell us about our human sentiments. Equity markets are very similar. It's probably the safest in the long run, but it is the most fearful as well, because at the end of it, in a shorter run, and if the decisions are made in a rush, people tend to lose money. But we don't understand that in a longer run, really the best way to invest is equity markets. So we should take cues from our day-to-day life and try to relate that with the equity and with our investments as well, because at the end of it, it is the markets and everything are all driven by human sentiments, are driven by stock prices, which are again the companies of which companies are managed by humans. So it's the human factor is something that cannot be ignored, right? So again, so our memory is very short. What happens is when we see a rally, when we see markets going up for a longer time, and the markets have been going up from, I think, 2014 and October 2013, if I'm not wrong. So we tend to forget the jerks that come in between, right? So there are, after this, after a few minutes, I'll come to the jerks as well. That what all jerks we saw in the markets, and how did the markets react after those jerks, right? So first of all, the news that we are hearing, the dollar depreciation, the sorry, not the dollar depreciating, the rupee depreciating, and the crude prices increasing, is not the first time that we have actually heard that. Now, see what is happening because of the news articles, and because what we see in the media is, and with the coming of age of India in the digital medium, with the Digital India platform, what's happening is we get a lot of news, and we are unable to actually select which news are important for us, which news matter to us, and which news doesn't. So I was just reading the other day some data, you know uh, and this report was published by Amphi. Only 2% of investors invest for more than 10 years in equity. And that's a very astonishing number, because equity markets are actually designed for investors who can stay there for longer run. Uh, they can, bear the short term volatility. But still, out of all the investors that we have, only 2% of investors remain invested for 10 years or plus. And I think there is the catch, that what happens is we get intimidated by short-term news, by news which are not meant for us. We tend to bend towards redeeming our investments. But I feel that if a sense the most sensible investor is the one who goes by his goal, investing by his goals. There's no point taking out money when the markets are not doing well. It's always advisable, and we have kind of said that in all our meetings as well, that that equity investment is for a longer run. It involves a lot of patience. It involves a lot of bearing all these short-term news. But at the end of it, if you're there, systematically and with patience for a long time, or for a long run, you will always end up getting good returns from the markets. So coming to the markets are actually down. The crude and the dollar is just probably triggers, but we feel that the markets are down because the shares valuation was very high. In the markets, the valuations had gone really high for the markets, which I think is going through a time correction where such high valuations was not very easy to hold at a point of time. So I think that's just going through a time correction. That's one part. Second part, what's happening is so let's try and understand that why oil is going up now and why it was not. It was probably at a $35-$33 kind of a barrel mark a few months back. So what's happening is the overall economy, if we talk about the global economy, is actually growing at a good pace. So if I talk about numbers, the US GDP year on year is at about 2.90% as of now. Their yields have touched a 3.22% very recently, and the recent number, which was a Q-on-Q number for their GDP growth, is actually is actually very surprising at 4.20%. And along with that, the Eurozone, if I talk about Japan, all of these economies are growing at a decent pace. Now, what's happening is that the demand for oil from all these economies, from US, from Europe, from Japan, is increasing because these economies are growing. So due to which because of the rise in demand, the oil prices have also started going up. So we feel that $75 kind of a oil is something that I think everyone will get used to very soon. It is just a matter of time. See, what happens is when dollar increases at such a fast pace, and the crude increases with such a fast pace, the markets react in a short term. But after a while, they'll get used to these levels of dollar and crude, and I think we'll be in a more stable or in a more calm phase of the markets after that. So we feel that this phase should settle down very soon. Also because we see that ultimately the equity markets run after earnings, and earnings should come this year, next year, and the year after that as well. So we are pretty much not very bothered with the short-term correction which is happening. We're advising everybody that this is a good entry time, and not in a lump sum again, but in a systematic transfer plan or through an SIP. This is a good entry time to get into the markets at this level. But again, we have to be pretty cautious in the coming few months. So I'm again reiterating that it should be in the form of STPs or SIPs. If I'm saying that earnings should come now, and if the earnings haven't come in the last 3-4 years, what was driving the markets in the last 3-4 years was the liquidity. The pension money had come in, the SIPs flows, the domestic flows had increased. So that was what was driving the markets for the past few years. But now we feel that the earnings from this year onwards and from this year onwards and also the next year should start coming in, and market should perform well depending on the earnings that we get. Market generally runs after the earnings. So all the political news, all the crude news, all the dollar news are just temporary impact to the markets. In the longer run, the markets will give returns if you have good earnings out of the corporates, and will not give returns if you don't have the earnings. So now and also again, so coming to the fact, first of all, coming to some numbers, I just spoke about a couple of minutes back about the corrections that we saw, and I will attach the graph also uh, along with this audio blog. So if I talk about 2008, everybody knows the markets went down at that point of time. The markets corrected by more than 50%. That was because of the subprime crisis, right? So in 2009, again, first 3 months, the markets were down by approximately 15%. Anybody remembers what the reason was at that point of time? So at that point of time, the opinion polls that had come in had said that Dr. Manmohan Singh will not come back as the PM. So due to that, and also Satyam was there at that point of time. So these two news, the markets were down 15% for the first 3 months of the year. In 2010, again, the markets were down. That was, if anybody of us remembers, that was because of the Greece crisis that had happened at that point of time. In 2012, again, the markets were down by approximately 8%. This was again because of the fiscal and the current account deficit had gone up to the levels of 6% approximately at that point of time. In 2013, in 2013, markets were down by approximately 20 to 22%. And if anybody remembers the reason, at that point of time, the reason was again the rupee depreciating by approximately 18%. So, and after that, immediately after that, and this is a very classic example that, immediately after 2-3 months, the markets rallied, and the markets rallied in such a way that it didn't stop after that. So, again in 2000, I think, these are the corrections, which you can look at. And why I'm repeating all this is that, we should have a good understanding about the history also when we look at the current situation in the market, because this is not the first time it's happening. 2016, again, I think they remember. 2016, the markets corrected because of Brexit. 2017, the markets were down because Trump had come in. So every year all these years, there have been reasons, of the markets going down, but this has been always short term. So if you see a longer run of the markets, a longer graph of the markets, if you can see, the market's trajectory is always upwards. So we feel that, this is a phase of the market. It should, pass away soon. Market corrections are part and parcel of the game, so there's really nothing to worry about. If I even if I talk about crude, a lot of people have asked me that why oil prices are up. And there are a lot of reasons behind it, but see, I'll tell you a very honest and a candid opinion that oil prices are up because pehle gir gayi thi. It's as simple as that. So when there was no demand from all the, from the European countries, from US, from Japan, the oil prices had gone down. There was a point of time, I think, if I remember correctly, 110, 115, 120, $130 also per barrel, the, crude prices had reached. And this I'm talking about approximately 10 years back, when our per capita income was less. So if I take an example and talk in numbers, when we were earning approximately 50 rupees, 10 years back, we were paying about 100 rupees, 100 rupees for oil. And now, when our per capita income has increased, we're earning approximately 100, but we are, we have to pay only 80 for oil mainly. So, this, if you see in a longer run, so the markets are only reacting because the prices of oil had gone way beyond, they had gone way below the levels. Now it's somewhere, settling in some prices, and the markets are just reacting for that, reacting because of. So all prices that had gone down in 2015 because of the lack of demand, because the global economy not growing, the prices have started going up now because of the economy is growing. And we understand that this has an impact on the current account deficit. uh, but see, India is a growing economy, and India as an economy is more dependent on the consumption, the domestic consumption, rather than exports. So an economy which is dependent on consumption and not just exports, uh, will tend to have a current account deficit always. Uh, so as long as the current account deficit, the inflation figures, everything remains under a certain limit, we don't feel there is anything to worry as such, about the markets. So now the $1 million question is actually, what should an investor do, or what should somebody do who is invested or who is investing currently. So see, there are whenever we have advised our clients, we've advised them of very limited lump sums into equity. Mostly we've done equity investments through STPs or SIPs, or we've done investments through balance advantage and dynamic equity categories. So investors who are running the SIPs, I think they should continue to do so. If they can increase their exposure to SIPs, if they can increase their SIPs by any percentages, they should ideally do that now. People who have invested in the markets with STP and those STPs are still running, I think we should continue with the STPs. There is absolutely no disadvantage, or I'll say there's no advantage of stopping the STPs right now, because the markets are at down and we need a lower average. If we can top up those STPs by whatever percentage, that will be more helpful. So if the point is, if we have more liquidity with us, we should pump in the markets right now. And that too, again, we are reiterating that it should not be in the form of lump sums. It should be in the form of STPs or SIPs for the next few months, or let's say next 1 year. People who are invested in balance advantage categories or in dynamic equity categories, I think once the market level goes further cheap, I think these fund managers will start increasing their equity allocations. They have already started to increase a little bit of their equity allocations, but that's the advantage of balance advantage and dynamic equity categories. People who want to start afresh, STPs and SIPs are the only way forward. Now we get a lot of questions on, if we have to go for equity, then which asset class in equity we should go for. And I'll say a diversification in the asset class would be advisable. But for us, if you ask us, mid cap and small cap categories look very attractive to us. Why is that? Because these categories have got the most beating. As I said earlier in the call, that small caps are down by approximately 35-36%. Mid caps are approximately down by 24-25%. And this I'm talking about relative to the index. Some stocks have even got a worse beating than that. We know about stocks in small caps which have also come down by approximately 70-80%. DHFL, for example, had come down 70% in 40% in 1 day, and Infibeam, kind of a stock, came down 70% in 1 day. So there are a lot of stocks which have got a lot of beating in this category. There are some exclusive sectors which are predominantly in small caps. So if you have to invest in such sectors, the companies or the sector is not big enough to have a large cap kind of a stock in that sector. So for example, if I talk about air conditioners, if I talk about couriers, if I talk about glass, if I talk about industrial gas, if I talk about laminates, if I talk about packaging, if I talk about rubber, if I talk about sugar. So all these sectors, all these categories are only available in small caps because the sector is so small that a large cap there's no large cap company in this sector. If I talk about mid and small cap on a whole, all hospitals, all hotel chains, all retailing, breweries, construction, all of these companies are more or less airlines. If I talk about, they are more or less mid and small cap stocks according to the recent SEBI recategorization. So, we feel that small and mid cap, one, because they are I'll not say so they are not dirt cheap as of now, but the valuations are pretty much okay there. They are not crazily expensive right now. The valuations are all right. They have corrected by a huge amount, by approximately 36% on an average. So, this sector, mid cap and small cap, looks good. Also, I feel that the mid and small cap sector is actually, there is a lot of under researched potential there. So if I talk about large caps, for example, in large caps we have about 33 to 34, I think, large cap average analyst coverages which we have. In mid caps we have about 15 average analyst coverages, but in small cap it's actually around 8 small cap average analyst coverage. So it's under research potential is pretty good in the small cap and the mid cap category. So a small cap SIP or STP should be a good investment bet to do right now. Or what we can there. So in small cap category, we are also, there are some NFOs which are running. I think Tata is coming up with an NFO, and Invesco is also coming up with an NFO. And the advantage of investing in an NFO is that the fund manager has a liberty of investing that money in the, not immediately, but in probably in the next 3-4 months. So these NFOs also look attractive to us. If not these NFOs, then we can go for any existing small cap funds also in the form of STPs. So large caps, and so large caps, having large caps in your portfolio will only make your journey towards wealth creation a bit stable. But if we need actual returns, if we need good returns from the markets after a few years, small caps and mid caps, I think, are the ones which should deliver those returns. But of course, with a lot of volatility, these stocks are very volatile. So only investors with a good risk appetite, with aggressive risk, should go for these small cap and mid cap categories. For conservative investors or for moderate investors, mainly we have balance advantage category, which has looked good to us for the past 1 year, and we've started recommending on the balance advantage front as well as the dynamic equity front, where according to the market conditions, the fund manager has the liberty to increase or decrease equity, and the equity portions are generally between, in some funds, even 10%, and they can go up to 80-70% approximately in these funds. But they will go at higher levels only when the markets are down, when the markets are cheap, are available at a cheap level. Otherwise they'll not go, because they track price to earning and price to book value depending on different funds in these funds. So those look attractive to us. On the PMS front, we recommend PMSs which have a larger portion of small cap and mid cap. So Edelweiss, Hexagon is there, of course, and there are some other PMS, Motilal Oswal, ICICI, Sundaram. So there are some other PMSs as well, which have been doing well. SPI is also there. DHFL is also there. But we again, recommend to go through an STP in these PMSs. Some PMS have an option of STPs as well. In small cap and mid cap PMSs. Uh, if this audio blog is floated across in a form of a mail, we'll try to attach the presentations of the small cap funds as well as Edelweiss, Hexagon, and few other PMSs also along with that for you to study. So, in a nutshell, to summarize, what I have to say is, don't worry about the current market situations. It has happened in the past. It will always happen. It's a part and parcel of the game. The corrections will keep on going, keep on coming. What is important is being patient in this kind of a market, increasing investments in this kind of a market, and being systematic in these kind of a market. So don't get bogged down by the news. The more news articles and news samples that you hear in media about panic in the markets, about markets going down, about markets not performing, just assume that when this is happening, that's a good time to invest. And regardless of what your fears tell you, it's always better to invest in such kind of a market through SIPs and STPs or balance advantage plans. Right, so I'll take your leave. Thank you for hearing me out. I hope I've been able to answer some of your questions. Otherwise, I'm always available on my mobile, and I'm always available on my email, abhishek@ingenetis.com. You can follow us on Facebook, you can follow us on Twitter, you can follow us on LinkedIn, you can follow our blogs, and we keep on posting such updates on all these social media platforms. Any questions, any queries for me, we'll be more than happy to address all those questions. Right, thank you everybody. Thanks for hearing us out. Thank you.